We all know that money doesn't grow on trees, but did you ever hear about the money tree that grew on Wall Street? Yeah, neither did I, because it doesn't exist. But that's where mutual funds come in. You see, in the realm of finance, there's a mythical beast, a creature so powerful, so potent, it can make your money multiply, if tamed correctly. That beast? Mutual funds. Imagine a money tree that sprouts dollar bills instead of leaves. Sounds fantastic, right? But remember, even in this whimsical world, there's no such thing as a free lunch. Your money tree would need some nurturing, some attention, and yes, a little bit of risk. But don't worry, this isn't the Wild West. There are rules, strategies, and some handy tools to help you on this journey. Now that we've cleared up the existence of any money trees, let's dive into the world of mutual funds. So, you're probably wondering, what exactly are these mutual funds we speak of? Well, imagine a big pot of money that's contributed to by a group of investors, like you and me. Think of it as a financial potluck, where everyone brings something to the table. But instead of casseroles and pies, we're bringing cash. Now, this pot of money is managed by professionals known as fund managers. Their job is to strategically invest this money into various assets like stocks, bonds, or other securities. The goal? To make that pot grow. Imagine the fund manager as a master chef. They're taking all these different ingredients, our investments, mixing them together, and trying to cook up the most profitable dish. But remember, just like in cooking, there's no guaranteed recipe for success. Sometimes even the best chefs can have a bad day in the kitchen. So, mutual funds are like a potluck party for your money, managed by a very smart chef. Sounds interesting, right? Like anything in life, mutual funds have their pros and cons. Yes, even the smart chef can sometimes burn the soup. Let's start with the positives. First and foremost, mutual funds offer diversification. Think of it as not putting all your eggs in one basket. By investing in a mutual fund, your money is spread across a variety of different investments, from stocks and bonds to commodities and more. This can reduce the risk of losing your entire investment if one company or sector performs poorly. Secondly, mutual funds are managed by professional fund managers. These are the culinary wizards in our soup analogy. They have the expertise and resources to research and analyze market trends and make informed investment decisions. So you can sit back, relax, and enjoy your metaphorical soup without having to do all the cooking yourself. Thirdly, mutual funds offer high liquidity. This simply means that you can buy or sell your mutual fund shares on any business day. So if you suddenly find yourself in need of cash, you can quickly turn your mutual fund investment into money. But as with any investment, mutual funds also come with their share of downsides, the first one being potential risk. Despite diversification, mutual funds are still subject to market risks. If the market takes a downturn, the value of your mutual fund shares could decrease. Another disadvantage is fees. Mutual funds charge management fees, which can eat into your returns. Some funds also have sales charges, which you pay when you buy or sell shares. It's like paying for a soup and then being charged extra for the spoon. Lastly, unlike stocks where you have complete control over what you invest in, with mutual funds, you have less control. The fund manager makes all the decisions about which securities to buy or sell. So if you're the kind of person who likes to have a say in what goes into your soup, this might not be the best option for you. So while mutual funds can offer a convenient way to invest, it's important to remember that a burnt soup can sometimes leave a bitter taste. Now that you're all geared up about mutual funds, you must be thinking, how do I get started? Well, it's easier than you think. The first step is to choose a platform that suits your needs. Some popular options are Vanguard, Fidelity, and Charles Schwab. Each of these platforms offers a wide range of mutual funds, so you're sure to find something that aligns with your investment goals. Next, it's time to do some research. Look into the performance of various mutual funds, their management fees, and any potential risks. Remember, while mutual funds can offer good returns, they're not without risk. Finally, once you've done your homework and chosen a mutual fund, it's time to make your first investment. Start small if you're unsure. You can always invest more later. Remember, the journey of 1,000 miles begins with a single step. And in the world of investing, that first step could be exploring mutual funds. So, are you ready to take that step?